one of my first deals when I got into the business, I was comparing a detached property with a semi-detached property. I was comparing a property that had brick exterior with vinyl. I was comparing like apples with oranges.
Yeah.
I probably was even comparing fruits with like salads. Not even fruits with fruits. Like it was it was like just not comparable. But do you have those key data points that you say, what, if you want to get a like for like comparable, you have to compare maybe the square footage versus the square footage, the frontage versus frontage, the exterior versus exterior. Like, what are those key data points to take into account when doing deal analysis? Welcome to the Deals Estate Wholesaling Podcast, where we discuss finding, financing, and facilitating off-market real estate deals. I'm your host, Deji Odunton, and I'm joined today on the show by Ryan Day to discuss and share his knowledge on how off-market deals are financed. Ryan is a real estate investment success manager with Calvert Home Mortgages. You'll probably have heard about him in the off-market space. If you haven't, then what are you doing? In today's episode, Ryan and I discuss the ins and outs of financing off-market real estate deals. We discuss who the key players are in the off-market space. So when you think of the MICs, you think of the brokers, you think of the banks. We discuss all that in this episode. And finally, we discuss how the current investment landscape is changing how they basically fund investors and fund their deals. So if you are listening to this episode, you do not want to miss this. Be sure to listen to the very end. Before we dive into today's episode, we want to say a big thank you to everyone who is tuning in. If you are a fan of this podcast, please hit the like, subscribe, and notification buttons, and we would appreciate a 5-star review. So without further ado, let us dive into today's episode. Hi, Ryan. Welcome to the Deals Estate Wholesaling Podcast.
Deji, thank you so much for having me. Really appreciate and take the time out of your busy day to have me on your podcast. Looking to really share as much value as I can to help the whole real estate investing community and obviously your audience. So really looking forward to it. Really grateful for the opportunity.
Thanks a lot, Ryan. And it's really a pleasure to have you here. We've been having this conversation for a very long while, and I'm super excited that you're here today to share your experience and your knowledge with the entire community.
Definitely. Yeah. Looking forward to it.
Okay. So before, we get ahead of ourselves, I know a lot of people would want to learn more about you. Who am I speaking with today? So if you could tell us about yourself, who is Ryan Day, and why should people be listening to this episode?
Yeah, for sure. Definitely on the professional side, really have a passion for sales and business development. I really love human psychology and really just understanding the psychology behind why people sell and just connecting with individuals. So background really quick, was in sales pretty much my whole life. Worked at Coca-Cola, was a sales rep for Heineken, and then Molson Coors, the beer company that I'm sure you're familiar with, and really wanted to build a real estate portfolio. So I have a few properties myself and had a passion for real estate and just the wealth that it can generate. And it's something that significantly interests me, obviously outside of work. I found a great private mortgage lender that tailors specifically lending to real estate investors. So applied for the company, completely hit it off with the VP, Jesse Bobrowski here. We really match in terms of personality, ethics, values, and goals. So I thought there'd be no better place to learn real estate than a private mortgage lender who's been doing it for over 45 years and take all of the learnings that I learned inside of work and the relationships and the individuals that I meet with on a daily basis and leverage those outside of work. So very symbiotic in that sense. Professionally, that's kind of, the Coles notes. On a more individual level, absolutely love. I'm a big fan of hot yoga and meditation. I did a silent meditation retreat in Thailand quite a few years ago. And then traveling as well too. Backpacked Asia with a really good buddy of mine for just under 4 months, fresh out of school. So quick little bit overview about me, and then also absolutely love personal development, books, workshops, just in order to fine tune the skill sets and just try and compound the skill sets over time. So quick 45 second summary of me, what I do professionally and kind of outside of work.
Well, that's powerful, man. So with all the personal development that you've gone through within the real estate space, which would you say has had the most impact?
For sure. I actually completed not too long ago. It was a negotiation course. So it was a 6 weeks course 1 hour a week where you do mock negotiations. So
Okay.
you come in and there's an example that you work for an automotive company, you get pistons at 79 cents. You have a buyer that's looking to buy 1,500 of them. You're oversupplied currently right now, and you're in a mock negotiation with another vendor looking
Yep.
to sell these pistons to this automotive dealer. And it's really cool to just understand what your fixed costs are, what your variable costs are, what bargaining chips that you have on the table. So you essentially have a whole script
Okay.
on the background of what you know and the assumptions going into the negotiation versus the other side. So just really fine tuning that. I feel like negotiation, one of those skill set. Obviously, you probably know better than anyone working in the wholesale business and real estate business, but it's one of those things that over time, if you really hone in that skill set, I feel like it'll just pay immense dividends on the long run.
Okay. So a lot of the wholesalers and realtors that are listening to this episode, should we be worried having you on the other side of the negotiating table? Where we're
I
able
don't think so. We try to do what's the best interest. Obviously for the company that I work for, but we do have quite set and standard rates and fees.
Yep.
As long as the deal makes sense on the borrower side, we always try and do whatever we can to get the deal done. At the end of the day, I know it is a very competitive market with hundreds, if not thousands, of other individual private lenders, other mortgage investment corporations. But outside of pricing, I know there are other things to look at in terms of how much capital that the MIC has access to, turnaround time, if they require appraisals, yada, yada, yada. So
Okay.
there's other stuff outside of pricing and fees that we'd like to think that offers a lot more value proposition as opposed to rates and fees that happy to get into in this conversation.
Okay, perfect, man. So you've spoken a lot about your personal self, and you've mentioned that you work with Calvert. So maybe you could give our listeners, an insight into who Calvert is and essentially how Calvert has come to become one of the most prominent names in the private lending space.
Yeah, for sure. So the company's been around for quite a while, 45 years, based out of Calgary. So started lending in Alberta over 45 years ago from our founder,
Okay.
Everett Keller. And he really honed in and found a really unique niche that banks hate lending to people who flip properties. They hate the short-term types of loans. So he really noticed a unique space in the market to start lending his capital and then another family's capital as well too, short term to these real estate investors. He's a real estate investor himself,
Yep.
and noticed there was a very lucrative opportunity of unmet demand for lending to these flippers in the space. So that's kind of developed over time.
Yeah. Yeah.
We became a mortgage investment corporation in 1982. So we're subject to the Income Tax Act and regulated by the CRA. So essentially,
Okay.
we raise capital from individuals, primarily accredited investors and permitted clients,
Okay.
and we lend out their capital short term and then pay them a return on an annual basis for the capital
Okay.
that they borrow, that they lend to us. And then we also have a credit facility from a few of the big institutions. So we borrow capital from the bank, ideally as much as possible, because that's going to be the cheapest capital that we
Okay.
can lend out to boost up investor returns for our company. So quick
Okay.
overview kind of on the history of that.
Yeah.
And yeah, I've been starting lending in Ontario for the past 3 years now. Noticed that
Okay.
there's lots of opportunity, but I know the market was obviously hit quite hard about a year or so ago with
Yeah.
prices decreasing depending on the community, property type, and location, like 20+%. So just navigating that. But since Calvert's been in business for over 45 years, the Calgary and Alberta market as there's had so many ebbs and flows.
Ups and downs. Yeah.
Exactly. Navigating risk in a turbulent market like that has definitely offered a lot of policies and procedures that we've implemented in order to mitigate risk and
Yeah.
not see borrowers go underwater and manage risk for our shareholders.
So can you maybe share more about that? Because it's actually interesting that there's so much worth of experience, going through the ebbs and flows that you mentioned over 45 years. So what has that taught you guys with respect to, as you said, the policies and processes that you put in place to ensure that, these market cycles, don't cause unnecessary risk?
For sure. So first thing that we do when the Ontario market was increasing, at the rate that it was, we definitely put on our conservative lenses. So if it wasn't a home run deal, we really monitor the HPI. We currently employ 4 appraisers in-house as well too. So we'd like to think we have a really good pulse on the market. So whenever someone brings us a new deal, having those expertise in-house, we're able to report back to the whole underwriting team and the company as a whole on, okay, 2 months ago, this valuation's dropped, 10, 15%. Or whatever the number was, depending on the city. So we really flag those markets of concern, but then also reduce loan to value. So that's a really good lever in order to increase or reduce risk, is just reducing loan to value. So we were doing up to 80% loan to value of the after repair value when we were lending on our flip and BRRRR projects. Depending on the market, we decrease that to 70% or 75%. So just really understanding where the market's at on a weekly basis, flagging that throughout the company, and then reducing loan to value as a result.
Okay, so right now, on average, where would you guys say you are with respect to like loan to value and where the market is right now?
Yeah, for sure. So our total portfolio right now, our average loan to value is just under 60%. So we like to think a really low loan to value for our overall portfolio. Something that makes us really unique is because we do take a look at the after repair value. A lot of our clients put 20% down. So if you're buying something for 500 grand, you're putting 20% down. The average renovation that we see is around 70, 75 grand. $500,000 purchase price. Typically the ARV, again, it really depends, but like 650, they try and boost up the ARV as much as possible. So on an after repair value basis, it is a quite low loan to value.
Okay. And quick question. So just taking a step back, because you mentioned that you guys are mixed, and you highlighted the fact that you are playing in a space that traditional banks, historically have chosen not to play. Do you know the reason why banks have chosen to stay away from the space that mix are taking up? And another question would be, aside mix and banks, are there any other players in the lending space, that really serve a different need for investors?
Yeah, for sure. So banks typically like the long-term loans. Like they want to lend their money out and know that it's going to be out for 5 years. They deem it high risk, lending their capital out on something such short term. Because we have appraisers in-house and we have those expertise in-house and we've been doing it for so long, we really understand that risk and we're extremely comfortable with it because we've been doing it for so long. So those are the primary 2 reasons right there that banks typically don't want these types of loans. From a capital standpoint, it is very labor intensive. Having immense deal flow where you can lend out your capital for typically on these loans, it's around 6 to 9-ish months. So having that velocity of constantly churning your capital around on an annual basis, it is something that is quite labor intensive. So whenever the deal flow starts going down, we really need to, my job primarily is hunt a few deals for finding, phenomenal wholesalers like yourself, brokers, real estate investors, see who's doing what in the marketplace in order to increase that deal flow. So primary reason, banks just deem it too risky. They don't want the short-term stuff. We specialize in it. So we're very grateful that the banks don't want this type of business just because it has been obviously a successful endeavor for us. Yeah. And then part 2 to your question, competition. So there are tons of, mortgage investment corporations. You could even probably take a look at hypothetically credit unions or individual private lenders. Yeah. From a mortgage investment corporation point of view, we find it definitely holds a lot of credibility from borrowing from someone who is a mortgage investment corporation. We have heard of horror stories of individuals borrowing from individual private lenders. Obviously, just do your due diligence. Like I'm not going to say all individual private lenders are shady. All of them, I'd imagine, hopefully all of them are obviously great lenders. But whenever you are borrowing from an individual, it is good to understand what a worst case scenario looks like. Like we've had a lot of lenders that we've heard of just call their loans whenever the term ends and not being flexible with the borrowers. So with that said, just really do due diligence on other individual private lenders. To your point, you really need to, whenever you have a private mortgage, compare everything on an apples to apples basis. Yeah. There can be so many hidden administrative fees, renewal fees, discharge fees. Like the fees can just really add up. So if you get a loan for a private lender at, say 10% plus a 2% lender fee, and there's another private lender offering, 2% and a 9% rate and a 2% lender fee, but then they tack on a discharge fee. There's a renewal fee after 3 months. There's a prepayment penalty. Like you just really need to be comparing apples to apples and understanding the total terms, fees, and value proposition. Just because rate and term, obviously it is significantly important, but it isn't the end all be all when comparing different private loans.
Okay, perfect. You had mentioned that in comparing Calvert and individual private lenders, that there's the additional value that you guys provide, and when a deal goes well, it goes well, right? But it's when the deal goes bad, that, as you said, you would really know, like how good the lender is. So from your standpoint, would you say Calvert provides some additional value to investors or to wholesalers or, to anyone who is taking your loans in an event where things don't go exactly as planned? Like, how do you guys provide value in that instance?
Yeah, for sure. So we've definitely, when the market was decreasing really significantly, we called all of our borrowers who bought at the peak. And then say if 2-3 months have gone by, we called all the borrowers. We understood where their projects were at because, 65% of our business, 75% of our business was flipping. It's now 65% of our total portfolio is on these flip and BRRRR loans. Okay. So we just really want to understand where the project's at, how far along are they, understand if they have the capital on hand to finish the project, and just really try and get ahead of those problem files, I guess, so to speak. But we are on a common sense approach. Like we've had a lot of people where we have extended the mortgage. We just really want to understand, are they going to be on time, on budget? If they need, if they need a lifeline, we've definitely done favors. We really try and be a long-term relationship lender as opposed to kind of one and done. Exactly. Transactional. So just because we've been around for so long, we are quite diversified in terms of cities, provinces as well too, and different mortgage products. So we'd like to think we are quite flexible when if you are in a tight situation. The worst thing that borrowers can do is suffer in silence. I know it's a tough call to make. Like if your next mortgage payment's coming up and you have $2,000 on the bank and your mortgage payment's going to be $5,000. I know it's extremely uncomfortable. Honestly, from a lender's point of view, just make the call. Just put all your cards on the table. It's when clients turn off their phones, don't respond to emails,
exactly,
rogue on us. We haven't heard from them in a month or two where, unfortunately we are a business. So then we obviously have to take the legal route. But if you're just honest, open, and you do everything with integrity, we're going to do everything in our ability to make things work for yourself if you are in that situation.
Perfect. Yeah, that's definitely very comforting. Thanks a lot for sharing that, man. So you mentioned something that was a segue to my next question. So you said that flipping was about 75% of your business and now it's 65%. What types of projects do you guys fund on? So if it's not the flipping projects, what other types of projects do you guys fund?
Yeah, for sure. So as mentioned before, a big portion of our business was the flip and BRRRR mortgage products. We brand ourselves as just a short-term lender. We define short-term as 12 months and under. So there's different types of mortgage products. One specifically called the bridge loan. So say if you're selling your house, you're familiar with the bridge loan? Okay, perfect. Yep. Okay, so we do bridge loans, something we call interim purchases. So say if you're buying a pre-construction condo, A lender, B lender pulled out in the 11th hour, you have something that closes on Monday. We'd be able to come in, provide you a mortgage, just really short term, just so you're able to close on the property. Yep. Something that's really unique is we lend on the as-is value, not the purchase price. So say if you got a condo in Toronto for $600,000 5 years ago, closing's coming up, it's worth $800,000. We'd actually lend on the $800,000 value.
Oh, I see.
You're able to obviously put ideally no money into the deal because the equity's baked in from the appreciation. So those other, call it 2 mortgage products, primarily make up the bulk of our other business. We've seen a lot of people who just need short-term mortgages for unique situations,
Okay.
or even pull out equity on their properties. We do a bit of it here in Alberta where it's at 55% loan to value. They're looking to take out equity in their current property to renovate another property. So we do something called a second mortgage, where we essentially pull out equity in their property, go up to 75% loan to value in second position, give them the funds, and then they sell the property, they pay us out. So we're able to get really creative with, as long as it's short term, we're going to do everything in our power to try and get a deal done. I'm sure you're obviously the same when it comes to finding off-market properties. It's just really just understanding what matters to people, what they're looking for, and just trying to be a good problem solver with ticking all the boxes in a way that makes sense for everyone, where everyone's winning. And it's not so you have one side winning where they have all the leverage and the other one feeling that they're getting taken advantage of. You really have to make it mutually beneficial.
Yeah. And one thing I want to point out is the fact that for a lot of these deals that you guys are able to come through on, there needs to be equity in the deal, for you to be able to fund on it. Like if there's negative equity, I believe you guys wouldn't touch those types of deals. Like the reverse of the case of the condo, where instead of an appreciation, it was like the market was coming down, and then the as-is value was lower.
In that case, if the as-is value decreased, they'd have to put more down. So yeah, whatever the value is as of today, we'd look to lend up to 75% on the value as of today. Depending on the market, that could go in your favor, or that could be the complete opposite, and you'd have to be putting more in your pocket, unfortunately.
Yeah, hopefully it's not the opposite. Okay.
Yeah.
So you mentioned that you guys started off with Alberta and then you moved to Ontario. Are those the only two locations you fund in, or are there other locations currently or in the future that you guys are looking into? And how do you decide which locations to come into to fund? Like, are there metrics that you guys track?
Yeah, for sure. So we definitely look at the size of the market. Obviously, Ontario is the biggest market in Canada, so that was kind of the next market that we were looking to try and take advantage of. So we've been in there for 3 years. We still feel, with us just being in there 3 years, there's so much opportunity. Currently, Ontario makes up around 45% of our business. It was 65% at the peak. So it's kind of roles of reverse from Alberta to Ontario in terms of market share for our specific portfolio. So we still feel like there's just so much opportunity there. We really look at the market fundamentals as well too. The market that we're looking to go into next will be British Columbia. We're building out our business plan for what cities, areas, communities kind of make most sense, but we really focus on the lower end to mid-market price point for single-family detached homes. Reason being is just that it has the most data points. It's typically the most consumed real estate. In a worst-case scenario, if you ever need...
it's the most liquid.
If we ever need to offload, or if someone's in foreclosure or power of sale in Ontario, it's the most easy to dispose of. So primarily for those reasons, we really focus on major urban city centers, as a lot of lenders do, but that's kind of like some insights on why lenders typically focus on cookie cutter properties and major city centers, is because it's the least risky.
Yeah. Okay. So within this market, do you also have preferences as to the cities within the markets? Because I've heard in the past that, for example, if there's a deal in a market of maybe 1,000 people, you wouldn't touch it. Like, are there criteria, requirements that you guys have, even within Ontario, Calgary, that you would take into account when analyzing a deal?
Yeah, very good question. Very good question. So our rule of thumb is there needs to be a population 10,000 and above. For all real estate investors out there, a really good rule of thumb is populations 50,000 above. Try focusing on those markets. Reason being is if a community of 10,000 is really concentrated on one sector and something happens to that sector, it's really easy for that population to significantly diminish. 50,000 people, typically it isn't so. Obviously, it depends on the area and location. It can be a little bit more diversified. The only caveat to that is Timmins. We don't lend in Timmins, unfortunately.
Oh, right.
And I know. The reason being is just nothing's really close to it. It's so far away from everything else. So I think they have a population around 45,000. I've had quite a few people, real estate investors, reach out to me like, Ryan, you got to change this. Like, it's hot. Purchase prices are really low. Really good opportunities. So those are the primary reasons
Okay.
on the markets that we focus on. But majority of our business is population's 100,000 above. So a third of our business is in Calgary. Probably around just under 10% in Edmonton, and then you have like Ottawa, Kitchener, Waterloo. We had quite a bit in Windsor actually, but those major urban city centers and primarily southwestern Ontario is where we like to stick to.
Okay. So in the case of Timmins, are there any other small cities like Timmins that maybe meet the population criteria, but for some extenuating circumstances like you mentioned, maybe the location is a bit odd or weird? Are there any other cities similar to Timmins that also fall in that same category?
That would be the only one off the top of my head. The primary reason as well too, is we need to have MLS access to wherever we are lending.
Oh, nice.
In.
Okay.
We don't have MLS access to that board. St. Thomas, as well too. We're looking to get access to that board currently right now, so we'll look to hopefully start lending there in the very, very near future. With that said, like if you're a real estate investor and you have properties in those cities, so say if you have a single family home in Ottawa and there's enough equity in that property, we could look to set up a second mortgage or a collateral charge on the property in Ottawa for you to purchase the property in Timmins.
Oh, I see.
That could be a decent amount of equity. The client would have to be good. Like there are obviously some caveats. I don't want everyone, call and say, hey, I have other properties elsewhere. Can we set up a collateral charge? But we're going to definitely try and do whatever we can to get the deal done. And because we have in-house appraisers, everything's for free. Like I know if you have a portfolio of properties, it can be so laborsome with arranging an appraiser to come to your properties. If there's tenants in there, just the back and forth between scheduling the appraiser to come in. I know you guys have some wild tenant landlord laws. It's for a different conversation, but on our end, everything's for free for the clients. So if you just want to understand how much equity is in your property and try and use that equity to scale your portfolio, we'll easily look at that for free as long as you submit like app credit NOA. We have your personal information on file.
Okay, perfect. And this is critical because for a wholesaler who is looking to either decide what market they want to focus on, it's helpful to know if your deals will be funded, right? Because if your deals, you get deals, but those deals are not being funded by one of the largest private lenders, then you could potentially be limiting your buyer pool. So, it's actually interesting that you mentioned that criteria. So thanks for that.
Yeah, no problem. No problem at all. Whenever it comes to the really, really rural stuff, like the lender appetite, just because the demand is so low compared to something that's in a major urban city center, you're just going to find the demand significantly lower. You'll probably be paying a premium if you're going through another private because there's more risk involved. So it'd have to be a really, really good deal. With that said, if you have a smoking deal and it's just outside of those limits, feel free to bring it to us. We'll give you our opinion, feedback, and suggestions. And if we can't fund it, we always try and refer it out to individuals in our network that we believe will fund it. So,
okay. So, quick question: you had mentioned that in-house you have the MLS access to a couple of cities. You have appraisers in-house. How does that compare to wholesalers, for example, that would use House Sigma to do comparables? How have you seen those comparables different? When you guys do it in-house versus when someone just does it off House Sigma?
Yeah, for sure, definitely. So it really depends on the individual and their methodology on how they came to the as is or ARV. Because we have licensed candidate appraisers in-house, they're just using the direct comparison approach. So we have a really handy tool where if you do have MLS access, you can download all of the property details into this spreadsheet.
Okay.
And then they're essentially just doing the direct comparison approach, comparing 3 to 6 comparables. And then they're doing adjustments for time adjustments, lot adjustments, if there's a garage, if there isn't a garage, square footage, kind of so on and so forth, to really just compare apples to apples. It's whenever those adjustments aren't taken into consideration and there's kind of a blanket valuation approach. They even take stuff into consideration, like if it backs onto a cemetery, if it's close to a highway, just because that does affect marketability. So there's just other variables to take into consideration that does drive the value of obviously of what a property will sell for, because really need to take into consideration who the end consumer is. Are you renovating to the market average? Is something that we always typically highly recommend and propose as well too. Don't try and over renovate, do something, trying to
more
be
than what the market needs. Exactly.
There's a reason why you see, luxury vinyl plank, kind of like an off-white colored paint, white baseboards, open concept kitchen, stainless steel appliances. Like, it's the look that everyone's doing, and it's the safest route to go. So most wholesalers, for the most part, are pretty accurate, pretty close, but I'm just not sure if they're going into all of the adjustments to come to the after repair value in their analysis.
And you just hit the next question that I wanted to ask, because I have like an Excel sheet where there's probably like 10 data points. So things like the year, the age, so the age of the building, like the frontage, the depth, like different parameters to do the comparables. But it seems like from your end, because you are seeing so many deals and you have appraisers in-house, you have like the MS Access, you guys know which of those data points are key, to make it like for like. Because I remember one of my first deals when I got into the business, I was comparing a detached property with a semi-detached property. I was comparing a property that had brick exterior with vinyl. I was comparing like apples with oranges. I probably was even comparing fruits with like salads. Not even fruits with fruits. Like it was like just not comparable. But do you have those key data points that you say, if you want to get a like for like comparable, you have to compare maybe the square footage versus the square footage, the frontage versus frontage, the exterior versus exterior. Like, what are those key data points to take into account when doing deal analysis?
Yeah, for sure. I could definitely share it with your audience. Like, I have the whole tool, spreadsheet, everything. We could even set up a webinar as well too, and have one of our appraisers, if that's something that interests you, teach have like an hour course. If you give us a deal, it could be fake, real, whatever you want to be, and be like, hey, can you value this property in real time? And you could essentially look over their shoulder. They'll share their screen and they could do a live valuation for you to really get an understanding of what. And I'll give you the spreadsheet as well too that we use internally.
Okay. So for everyone who is listening, get ready for the 1 hour webinar with Ryan and the team. I love it.
An appraiser that we have on staff. They'll be running it because they obviously that's what they do day in, day out. But more than happy, we just whatever would help the real estate community make better financial decisions. We're more than willing. Like, we're not territorial about that spreadsheet or our flip analyzer spreadsheet. We just really want to see people do good business and just be in the business for the long haul. And it's a shame when someone risks a lot of all of their investment savings. They put it in on one deal and they lose 10, 20, 15 grand. We really want to try and set people up for success and have them be in the long haul. So more than happy to arrange that and set that up for you and your viewers.
Perfect, man. Thanks a lot, man. We'll definitely be reaching out to you after this to set that up. Okay, so once an applicant has gone through this process and they know exactly what their deal is worth and they're coming to your team, how do these applications typically go to your team? I know that you could either go through brokers. Are people allowed to come directly to you, or do they only go through brokers? What are the different channels that applications filter through to your team?
Yeah, for sure. So currently, right now, 65% of our business are through mortgage brokers. The other portion comes directly to us. So if you are working with a broker, go through the broker. If you aren't working with a broker, feel free to reach out. So that's kind of a breakdown on direct through mortgage broker. But in terms of the process, we always recommend individuals get pre-approved with us. Pre-approval is really easy. It takes around 10 minutes to do. You fill out an application. You send me your most recent notice of assessments. If tax was owed, then just send me a statement of account showing that you're either on a payment plan or that you are up to date. and then proof of funds showing us that you have capital on hand to invest. Once we have those documents, we'd pull credit from the application to just understand what your credit looks like.
Okay.
Once we have that on file, we only need it once a year. So all of the legwork is done for a year's time. Everything else going forward is just related to the deal. So let's say if you handed myself that document and now you're just actively looking for properties. Once you find a property that you think is a good opportunity, send me the MLS listing or the buyer's package if it's an off-market deal. Your renovation summary. The more details, the better. We have a template that we use that I'll happily share with your audience as well too. But it's essentially just a contractor's quote. So it's an itemized list breaking down the scope of the renovation and the costs associated with it. The more detail, definitely the better. It helps with essentially twofold, providing you with a quicker response whenever I'm very clear on what your renovation is. Our appraiser is able to do a quicker valuation. And then number two, we're able to provide a more accurate valuation because they're very clear on the scope of the renovation. Like I've had one or two people reach back out, like Ryan, like ARV is not 700,000. I'm doing high-end finishings, granite countertops. And then they just didn't provide that context or that detail in the renovation summary. So the more detail you put in, the better. Once we have that, and you show us that you have the capital for to service everything, I'd hand that off to our appraiser. They do their valuation, and we'd be able to give you an answer within 24 business hours.
Oh, wow. Okay. So essentially, once the legwork has been done, which is you've submitted your file, you've done all the back-end admin work, if it's just analyzing the deal alone, you are able to give feedback within 1 to 2 business days if all the information is at your disposal.
Yeah. And say if you have a live deal like right now, we can just collect all that documentation and do it all at once, whatever the preference is. We also have people who will submit all of their documentation and say if they're going to view a property tomorrow night at 6:00, we do all of the work before they go and view the property. We let them know, obviously, by 5 p.m. the next day, what the max purchase price is that we would allow for. So they're going in eyes wide open. In that instance, they wouldn't need to put a financing condition because we've already given it our stamp of approval. So that's something that you can go in and, if it is a motivated seller, they want to sell, they want a closing for next week, then that's something we could definitely line up just because we've done all of our due diligence. So there's been quite a few real estate investors who use that to their advantage just because we are able to close extremely quickly.
Okay, so that's definitely something I want to touch on. So from a wholesaler standpoint, right? So you know how we are discussing with sellers and we get it under contract and we have buyers that are coming in. Is there a world where for those deals that we have under contract, those deals are already pre-vetted by your team where we're like, you know what, you don't need to go speak with the mortgage broker. Like there's already like a financing approval clause on this, or this already has gone through a certain process. Like is there a way any wholesaler can come to your team to sort of get that confirmation and then send that out to say, hey guys, this deal has already been vetted by this person or by this team or by this mortgage broker or by this financier, it's ready to go. It's a fundable deal.
Yeah. We could definitely look to set that up as long as it's a wholetail. If they're doing renovations, because the renovation scope can vary so much from individual to individual with a $75,000 to $100,000 renovation, that would really dictate the ARV. So it'd be really tough if you came to me and say, hey, I'm going to spend $50,000 on this house, going to put a new kitchen, bathrooms, paint, floor, trim. I would have to go off of the assumption, and it would kind of be a risk on our end, assuming that the client who buys it off you would do the exact same renovation. They're able to get materials at the same cost as you. So we could definitely look to do it at a wholesale because, typically you're just taking out garbage, putting in a fresh coat of paint, and that's pretty much it. So if it was a wholesale, we could definitely look to set that up. If it was a complete flip, I'd have to parking lot for now and get back to you on that. But that's definitely something I would love to try and set up because obviously that would hold a lot of weight and credibility on the wholesale.
Man, saying it's that would be sick. Like it would legit be sick because the entire journey from a disposition standpoint, when people do walkthroughs, then they say, okay, I'm going to get back to you. I'm speaking with my broker. That can take 1 or 2 days. It could take like a week. Well, if you are sending out a deal, and to your point, it's a wholetail deal. You say, okay, this is a wholetail. If you are wholetailing this deal, it's already financing approved. Then that, as you said, holds a lot of credibility. People are able to move faster. You're able to turn around deals faster.
Yeah, I think we could definitely look to set that up. We could even include our flip analyzer in there as well too. Show the numbers. Okay, if you're buying for $450, you put 20 grand down or 20% down.
Yep.
If you're just wholetailing it, what the numbers look like. It's already have the stamp of approval. I think we're going to be doing lots of business, Deji. I think we got
cool. I love this, man. This is more than a podcast. It's more like, okay, in addition to a podcast, we're also discussing like webinars and and other stuff. So yeah, that's great, man. Okay, so with all these things that we are discussing, how have all these processes, these policies, these ideas, how have they changed in the past 12 months? Like as you said, Ontario has been pretty hit in terms of valuations. Like how have all these policies and decision-making criteria within Calvert changed in how you guys lend now, given how the market is now?
Yeah, really, really good question. So it's something that we definitely monitor on a weekly basis. A huge component to our lending as well too is obviously interest rates, because we borrow from the big banks. Whenever the overnight rate changes, our rates change. So effectively, we have to increase our rates. So rates are definitely fluid. We're just doing a market consensus on, in the private lending space, what is the typical rates at an 80% loan to value mortgage? What are typical lender fees at? So it's just having a really good pulse on the market. In terms of loan to values, we are looking to increase our loan to value back to 75%. Hopefully 80 soon, depending on where the market goes. And I know there wasn't supposed to be any more rate increases, but obviously last week there was a 25 basis percent rate increases. But I think mainly it's communication. We have lots of meetings internally on understanding market feedback that we get from borrowers, so real estate investors and brokers, on, okay, what business are we winning? What business are we losing? What products does the market want to see? There's been a huge uptick from what we see on a daily basis of people getting into new builds, like new construction, multifamily, Airbnb, and then kind of on the non-investor side, the more retail homeowner debt consolidation. Unfortunately, with rising interest rates, inflation, rising costs, some people are getting really pinched. So if they do have a bunch of equity in their property, we could look to essentially put a second mortgage on their property, help them pay off all their credit card debts, give them a plan to get them back on track. Is something that in the past we have done. We do a little bit in Alberta, currently right now, not in Ontario. So it's just really understanding what mortgage products clients want to see, what's in demand, just because typical buy and hold, it's tough. I don't see how it's really possible to make the numbers work on just like 20% down buy and hold and anywhere in Western Ontario. Obviously you have your nuanced markets, maybe like Sudbury, Windsor. I've seen the numbers work, but investors are having to get really creative nowadays just to make the numbers work, to make it cash flow. If they aren't flipping and keeping something long term. So just really understanding what the market wants. We have some really good relationships with top real estate investors, mortgage brokers, wholesalers, and they do give us some really great feedback on, are people buying cash? We've noticed a big influx of people buying cash as of late. Typically they sold 1 or 2 properties when the market was hot, and just don't want to deal with the headache of going through dealing on the mortgage side if they are through A lender, B lender. So I know that was kind of a long-winded answer, but just having a pulse on the market, talking to players and adjusting your business as what the market wants. I know it sounds like a cliche answer, like have a pulse on the market. We always
you really went like you provided extra context, which is always helpful. And that actually took me to a question that I wanted to ask, because I know that you guys have a very unique perspective of the market, right? Because you are funding deals from different people, different wholesalers, different flippers, and you have like different clients across different products. If you were to share with us, like, of the deals that have maybe gone bad. And by
Mm-hmm.
bad, I mean, they weren't the home run deals, they were probably what you call the problematic deals. Of those deals, when you compare them with the deals that like home run deals, like what would be the trends that you see across those two deals? I think it's helpful for people that are listening, for wholesalers to understand, okay, what are the things I can take into account now that could tell me that, okay, this has the makings of a bad deal.
Mm-hmm.
Let me maybe avoid it, or maybe let me walk around it, or try to tweak it, versus this has the workings of a good deal. So with your unique perspective, historically, what have you seen have been the characteristics of those not so good deals versus the characteristics
Mm-hmm.
of the good deals?
Yeah, for sure. So the number one thing that we see where people are successful is buying right. If you can buy a property 5-10% below market value, you just really baked in yourself a cushion of solid equity that if things go over time, over budget, prices decrease, you've really baked in yourself a buffer
Yeah.
of a margin for error, essentially. So if you overbought, prices decrease 5-10%, you go 15%, 20% over budget, you think it'll take 3 months, it takes 4 or 5 months. That is the number one thing that we see successful clients who are doing 10, 11, 12 flips with us at once is number one, they're buying right. They're in and out in an extremely timely manner. They know what renovations they're going to be completing. A lot of them have materials on hand. So just
Okay.
to expedite their speed of their renovations, depends what type of level you are. Like if you're just, this is going to be your first flip, obviously it's going to be someone very different from someone who's doing, multiple flips at once. But number one, buying right. Number two is just definitely baking in a worst case scenario, ensuring you have a reserve fund. Where we ran into issues on our end was when individuals bought 2 or 3 properties in a very, very short period of time. They didn't have a margin for error. They stretched themselves way too thin. Prices decreased 20%. They thought it
Boom.
would take 5 months. It's taking 7 months. And they just really stretched themselves too thin. So I know everyone wants to kind of do the get rich quick, buy as many property scale as fast as you can. Obviously, that's awesome. I encourage everyone, if that's your plan, like nothing against you, but there's nothing about growing slow. There's nothing bad about growing slow. Uh, have your reserve fund baked in there
Yep.
and always forecast for a worst case scenario. On a larger note, from a lender's point of view, we used to do a lot of construction loans in Alberta.
Okay.
We don't really focus on those types of mortgage products too much anymore.
Okay.
From a lender's side, it ties up a lot of capital because you're typically, at
For a
around
long period of time. Yeah.
500 to $1 million. You draw out the money in stages or milestones. So like when foundation's in, when framing's up, you get more money at each milestone. So it ties up a lot of capital for a long period of time. It's very labor intensive. So you have to do site visits, ensure all the work's getting done. And for us, it had the highest foreclosure ratio for our book. And it was the least profitable just
Wow.
because we did a lot of it in Alberta. So prices, typically up and down. This is over the span of 40 years. This isn't, a recent time frame,
Yeah.
just
Yeah.
to give everyone some context. So
Okay.
for those reasons, we've noticed a lot of appetite for construction, but from a lender's point of view, for us specifically, it just didn't make sense.
Got it.
Yeah, the short term, definitely from a business point of view, where lenders make their money is actually on their lender fee. If we're able to lend out the same capital twice in 1 year, that 2% lender fee is
Yeah.
actually 4% because you're
Yeah.
recycling the same capital twice in 1 year. So more profitable. However, managing deal flow to get those loans and
Yeah.
have your
Yeah. True.
capital churn as much. It's a yin and yang. You're always balancing kind of one or the other. So yeah, hopefully that was what you were looking for. But like holistically, that's kind of what on the borrower side, and then like risk and what we're seeing different on the lender side from our business
Okay.
and what we're focusing on. Obviously, a big challenge for us is not as many people are flipping or BRRRRing.
Yep.
Just with how the market performed, we've noticed there's a lot of people on the sidelines with rates stabilizing and prices stabilizing as well too. We've noticed quite a few people come back and want to get back into flipping.
Okay.
So as long as you have a good deal, you try and buy below market value, and you have a reserve fund. Sky's essentially the limit. So
for reserve funds, do you guys have a metric, like a certain percentage of the purchase price or the construction fees? Like, what would be a typical cushion
yeah,
for?
for sure. So say if you needed $100,000, and that includes down payment, renovations, carrying costs, operating costs, and closing costs, try and at least have like on the safe end, like 20%. So $120,000.
Okay.
It really depends on how long you expect to be in the loan for. If you expect to have a project that's, $150,000 reno, it's going to take 9 months. Obviously, the margin for error, costs increasing,
Yeah.
is significantly increased. But if you're just doing something small, 20, 30 grand renovation, you're going to be in and out in 2 to 4-ish months. Then you can be a bit less conservative.
Okay. All right, cool. So, before we close this out, I remember that you had, I think it was on your website when I saw that, you guys had like this program called the Flip of the Month. I wanted to find out if you guys still do, that, or you still highlight those types of deals, like the ones that did well and the ones that maybe didn't do well.
Yeah, 100%, 100%. So we still do our flip of the month. Would love if anyone's on this call to highlight their deal. Obviously, we focus on the deals that we funded because we want to promote ourselves. But if there's anyone that has either used our products, our services, and would like to get involved, we white label it. If you want to have your branding, your logo, everything, we're more than happy to co-brand as well too. We really want to highlight the success of our clients. I know you're typically limited after a certain point to the number of mortgages you can get or the capital that you have. So we really try and eliminate that barrier by having a low money down product. And we've noticed a huge uptick in people trying to essentially do their own thing, build a brand for themselves. So we're more than happy to collaborate. Whatever clients think would help them reach their end goal, we're more than happy to help in any way possible. So would love to do educational sessions that I kind of mentioned, teaching them how to value properties, how to run numbers on deals, and highlight their success with a flip of the month.
Perfect, man. Thank you very, very much, Ryan. So that brings us to the end of this episode. But before we let you go, there is a question that we ask everyone, which is what your greatest L in real estate has been and what you learned from it.
For sure. I think, honestly, something that I'm kicking myself now is when rates were really low, I didn't buy enough properties.
Woo, tell me about it, man. My God.
Yeah, so that's definitely something in hindsight. I know when prices are going crazy, but like, oh my God, I just wish I kept on buying at that time frame. Just because, historically, it just obviously made sense, but you never realize the opportunity, more you realize in hindsight. So just really wish I bought more properties when rates were like 2%.
But at some point they would come down, right? And I believe when they come down, like, for sure, it's another opportunity again to jump in. But thank you very, very much for that. So thanks a lot, Ryan, for the time, for coming on the podcast. It was great to have you. And I'm really excited for this episode. Where can people connect with you if they want to find you?
Yeah, for sure. So if immediately, like if people have any questions, opportunities, emails Ryan at chmic.ca. So that's my email. Instagram's Ryan Day. The Calvert Instagram is Calvert Home Mortgage _. Or just, Google us, call our main line on our Google Maps listing. But really love what you're doing for the community. I love to see all the growth that you've had over the past, I think 3 years now. So keep crushing.
Yeah, this one 2 years. Yeah.
Yeah, you're doing big things. Love seeing your Instagram and showing the love and support. So if there's anything else that we can do for you, please reach out.
Thanks a lot, Ryan. And that's it, folks. So thank you very, very much for listening to the Deals Estate Wholesaling Podcast. If you enjoyed the show, please rate and review us on Apple, Google, and Spotify. And be sure to hit the subscribe and notification buttons so that when this episode drops and our next episode drops. So until then, remember, a deal a day keeps scarcity at bay.
Love it. Have a good one, everyone.